In this chapter, we're going to learn more about futures contracts. Now, in the previous chapter, we took a look at forwards and futures on stocks and stock indices, but as you probably know by now, futures contracts are written on a number of underlying commodities, not just stocks and stock indices. We're going to be looking at futures contracts on foreign currencies. We're going to be looking at futures contracts on different kinds of commodities. You can have futures on agricultural commodities. You can have futures on various quantities related to energy, such as electricity and crude oil and natural gas. And we're even going to take a look at futures contracts related to the weather and futures contracts related to real estate, which are more recent creations. What do all of these underlying quantities have in common if we step back and think about it for just a minute? Well, the most important thing that I see is that all of these quantities are uncertain in some way or another. And not only that, they also have the potential to create losses for people and businesses if they move in the wrong direction. So these futures contracts allow people with exposure to foreign currency movements, or perhaps people who have exposure to energy prices, or whose business is heavily dependent on the weather, or perhaps even real estate prices. These futures contracts allow those people to hedge their positions. Now, of course, they also allow speculators to make bets on those positions, but most of the time we're going to look at this from the perspective of hedging. So the first type of futures contract that I would like to talk about in this lesson is that on foreign currencies. Now, this is a very necessary tool because business is becoming more and more internationalized all the time. The trend is definitely in that direction. And of course, that means that you as a manager in a multinational corporation, you may have payables or receivables that are denominated in a foreign currency. And you may be receiving or paying a certain amount in a foreign currency, not necessarily today, but perhaps several months from now. And of course, your profitability is going to be affected by how many dollars that you have to convert into a foreign currency, or how many dollars that you might be able to convert back from a foreign currency that you receive. All of these things have a bearing on the business's bottom line, on its profitability. And for this reason, foreign currency futures contracts can be a useful tool to remove at least that portion of the risk from the equation. What you're looking at here is a Wall Street Journal listing of futures contracts that are traded on a number of different foreign currencies. You're looking, of course, at some of the most commonly used currencies in the world, and all of these contracts are traded on the Chicago Mercantile Exchange. There's a variety of information that these quotes provide, ranging from the opening futures price for the day to the high and the low that was reached during the day, and then finally the closing or settle price on the day's futures trading. And then of course the last two columns that you're looking at have to do with the change in the settle price from the previous day and the current open interest, which is essentially the number of futures contracts that are outstanding. Alright, now that we know the importance of currency futures and forwards, let's talk about how we would price them. Well, the good news here is that if you understand how to price futures and forwards on stocks and stock indices, then conceptually it's pretty much the same thing for forwards and futures on currencies. Let's take a look. In the previous chapter, before we looked at actual forward contracts and their pricing, we looked at prepaid forwards because it helped us make the next step in the calculational process. So let's talk about a currency prepaid forward contract. Let's say that you wanted to purchase a single Japanese yen 1 year from today, and you were going to do that using dollars. So, in other words, you're going to be converting dollars into yen. And the only question is, at what rate will that happen? Well, of course, if you wait until 1 year from today, you don't know what that rate will be, because the exchange rate between dollars and yen can and will fluctuate over time. But what if you wanted to do a prepaid forward contract? In other words, what if you wanted to pay for the yen that you're going to be receiving 1 year from today, but you wanted to pay for it in dollars today? How might you accomplish that? Well, as we saw last time, that's almost like just buying the yen in the spot market right now. And in fact, if I couldn't earn any interest on my Japanese yen by obtaining it today, then it would be the same price. But the fact is that I can, so a little adjustment will be necessary. Alright, remember how we calculated the price of a prepaid forward contract on a stock in the previous chapter? How exactly did we do that? Well, let's refresh our memory by taking a look at the previous chapter. We saw that if a stock paid dividends continuously, then a prepaid forward contract could be priced using this formula. S0, which is the spot price of the stock, what it's worth right now, times e to the minus delta t, where delta is the continuous dividend yield that's expressed on an annual basis. Now, how could that be used to price a forward contract on a currency? Well, the fact is that it definitely can. And in fact, the formula is essentially the same thing that you're looking at here. The only difference is that instead of S0, which is the current market price of a share of stock, you're going to have X0, which is the current market price of a yen. In other words, the number of dollars that you'd have to pay today, right now, to acquire 1 yen. By the way, it's useful to think of foreign currencies that way. It's very easy to get confused by all of the exchange rates, but when you realize that another country's currency is just something else that you can buy or sell with dollars, it makes it a little easier to understand. And of course, every currency is going to have a price. There's going to be a certain number of dollars that you can pay to acquire a yen or a euro or a Canadian dollar or whatever the currency may be. Okay, so instead of S0, the stock price, we have basically X0, the currency price. And then instead of this delta in the formula, which is the dividend yield on a stock, what we have instead is RY, which is the risk-free interest rate in the foreign country. That is, if you were to buy yen today and then just put them in a simple money market account in that foreign country, that's effectively the yield that you could earn. And that's analogous to the dividend yield from owning a stock. You see, if you buy a stock and hold it for a certain period of time, then you will be receiving cash flows that we call dividends. But if you buy a foreign currency and then invest it at the risk-free rate in that country, you'll be receiving a cash flow that we call interest. It'll just be at the foreign interest rate. So you see, this is really just the same formula that we had for stocks. There really isn't any difference, except that we've got an exchange rate, which is the price of a unit of foreign currency instead of a share of stock, and instead of a dividend yield, we've got a foreign interest rate that we would receive if we owned that foreign currency. So how does this model change if we want to look not at the prepaid forward contract, but just at the regular currency forward contract? The answer is it changes in exactly the same way that it did when we went from a stock prepaid forward to a stock forward contract. Remember that if a stock pays a continuous dividend yield, then the formula for the forward price is S0 times e to the R minus delta t, where R is the home or domestic risk-free interest rate, and delta is the continuous dividend yield in the stock, and of course S0 is the spot price. The only thing that is different here is that instead of having this factor e to the power of minus delta t, we have now multiplied this effectively by e to the rt, and so now what we have is e to the r minus delta t. And the exact same thing happens in the currency pricing formula for the forward contract. What we have here is x0, which is the price of the currency, times e to the r minus delta t, except that delta, in this case, since we're talking about a foreign currency, isn't exactly a dividend yield. It's a risk-free rate of interest in that foreign country. Alright, so this is your pricing formula for a foreign currency forward contract. And as hopefully you can see, it's really not difficult to apply. If you understood the forward pricing contract in Chapter 5 for stocks and stock indexes, this is the same thing. The concept is identical, so it should not be problematic. One implication of this formula that you might be interested in looking at is the idea of a forward premium or a forward discount. Currencies, just like anything else that has a forward contract written on them, can trade at forward premiums or forward discounts. A forward premium happens whenever the forward price is greater than the current market price or the current spot price of that particular asset, in this case a foreign currency. A forward discount, on the other hand, happens whenever the forward price is lower than the current spot market price. Well, in this case, this is the forward price of the currency, and this is the spot price of the currency, the current market price. So how will we know which one is greater? It all boils down to this term, e to the r minus ry times t. If that term is greater than 1, then you're going to have a forward premium. The forward price will be greater. If that term is less than 1, then you're going to have a forward discount. So how do I know whether that will be greater than 1 or not? Well, I'm assuming that t, the time to expiration, is some positive quantity. And so really it just boils down to the difference between r, the domestic rate, and ry, the foreign risk-free interest rate. If the domestic risk-free interest rate is higher, well, then you're going to have a forward premium. On the other hand, if the foreign risk-free interest rate, in this case Japan's risk-free interest rate, is higher than that in the US, then you're going to have a forward discount on the yen. Now, if that relationship does not hold, remember this formula is derived from a no arbitrage framework. So if for any reason you've got a country whose currency is trading at a forward premium relative to the other, and that country also has a higher risk-free interest rate than the other, well, then you've got an arbitrage opportunity, and that particular strategy basically just amounts to a cash and carry or a reverse cash and carry. In this case, with foreign currencies, we have a special name for it. We call that covered interest arbitrage, and I'll show you a little bit about that strategy momentarily. What I'd like to show you right now is a couple of examples based on what we've just looked at. Let's say right now that the yen-denominated interest rate is 2% over the next year, and that the current or spot exchange rate is $0.009 per yen. In other words, if you wanted to buy 1 yen today, then you'd have to spend 9/10 of a cent to do that. In other words, you'd have to spend $0.009 to buy 1 yen right now. So what if you wanted to have 1 yen a year from now? Well, you wouldn't have to invest quite as much. You wouldn't have to invest $0.009. The reason why is because if you were willing to prepay for the yen in advance, then you could invest a slightly smaller amount, go ahead and convert that into yen today, put it in a Japanese money market account earning 2%, and then you would end up with 1 yen a year from now. So what I have to do to figure out how much I need to invest really is just take today's spot rate of $0.009 and discount that at 2% continuously over a year's time. So I multiply by e to the minus 0.02. So let's go ahead and bring up our calculator and do just that. I know that you see the answer on the screen here, but it's always a good exercise. So we take today's spot rate of $0.009 per unit of foreign currency, and then we multiply that by e to the power of negative 0.02. Alright, and then of course we get our answer, the prepaid forward contract price of 0.00882. So if you took that amount of money and then converted it into yen and then invested it in a Japanese money market account over a year's time earning 2% continuously, then you would in fact end up with exactly 1 yen a year from now, which was what you had in mind with a prepaid forward contract. Okay, well, let's look at a very similar, just slightly different example. Let's say that the yen denominated interest rate again is 2% and that the dollar denominated rate is 6%. Again, the current spot exchange rate between the two currencies is $0.009 for 1 yen. That's the price of a yen. Okay, so what would not the prepaid forward rate be, but what would just the forward rate for a 1-year contract on the yen? What would that be? Well, it's pretty much the same formula as we're already used to. Remember I said that it's just the current market price of whatever the underlying asset is, in this case 1 yen, times e to the r minus delta, or in this case r minus the foreign risk-free rate of interest, times t, but right now t, the time to expiration, is exactly 1 year, so that doesn't affect anything. So what we have is 0.009, the spot rate, times e to the power of 0.06 minus 0.02. Remember, 0.06 is your domestic risk-free interest rate and 0.02 is your foreign risk-free interest rate. And so you see that your forward contract price is 0.009367. So as you can see, the yen trades at a forward premium relative to the dollar. Okay, now why did that happen? Again, it's because, like we said on the previous page, the domestic risk-free interest rate is higher than the foreign risk-free interest rate. So that's why the forward price of this currency is higher than the spot price. If that were not the case, if the yen did not trade at a forward premium, then there would be an arbitrage opportunity. The same currency cannot have both a forward premium on it and also have the higher risk-free interest rate. Now, I told you that if this forward pricing relationship did not hold, that is, if the yen forward price were anything else other than 0.009367 within reasonable parameters under these conditions, then there would be an arbitrage opportunity. The process of executing an arbitrage opportunity in this case would involve the creation of a synthetic forward contract on the yen. Let me show you how in fact you would set up a synthetic forward contract on this foreign currency. First, you would borrow an amount of money that is equal to the prepaid forward price on the yen. In this case, It's 0.008822, which we calculated earlier. Then you would convert that money into yen. In other words, you would pay this amount of dollars and purchase as many yen as you could at this particular exchange rate. Now, how do we know exactly how much that's going to be? Well, let's just go get our calculator and we'll see. If we have $0.008822 right now, and we convert that into yen, we've got to divide by 0.009, and we'll see that we get 0.9802 yen today. Okay, well now this amount will not be put under the mattress, so to speak. It will be invested in a yen-denominated risk-free investment. And we know that the risk-free investment rate in yen is 2% in this example. So we'll take this amount, 0.9802, invest it at 2%, and how much will we end up with on the expiration date 1 year from now? Well, we'll multiply this by e to the power of 0.02 to find out. And we'll see that, rounding error ignored, that will end up with basically exactly 1 yen. Well, that's essentially what we have. This is a synthetic forward contract. The idea is to replicate the forward contract, and the forward contract would definitely allow us to acquire 1 yen. Now, the forward contract would also require that we pay this price, 0.009367, for 1 yen. So, how is it that the synthetic forward causes us to pay that amount at time 1, that is 1 year from now? Well, the answer is we borrowed this money. Remember, we borrowed $0.008822 to set up the position. And since the risk-free interest rate in our home country is 6%, we have to repay that loan. So how do we know exactly how much we're going to have to repay? We take 0.008822 times e to the power of 0.06, because after all we are being charged 6% interest on this loan in our home country, and that's where the number comes from, 0.009367, with just a little bit of rounding error. So hopefully you see here that this is how we would create a synthetic forward contract on the yen. The resulting payoffs are identical to the regular forward contract on the yen. The net cash flow is 0 today, and a forward contract is that way. It requires no cash flow initially to get into. And then at the contract expiration, 1 year from now, it pays us 1 yen, and it requires us to pay the forward price of $0.009367. Now, if the actual forward contract price were higher than this amount, let's say that the actual forward contract price were 1 cent, for example, that would be $0.01. Well, then I would sell the actual forward contract. I would take a short position on that, and then I would buy this synthetic forward contract that you see illustrated here. And that would, for all practical purposes, be a cash and carry arbitrage strategy. On the other hand, if the forward price were lower, let's say it was only 0.008, well, in that case, I would execute a reverse cash and carry strategy. I would buy the forward contract on the yen, since it was underpriced, and then I would sell this synthetic yen forward contract that you see illustrated. How would I sell this contract? How would I take the opposite position? Well, Instead of borrowing in the United States, I would lend money in the United States. And instead of investing or lending in Japanese yen, I would borrow in Japanese yen. So the strategy would just go in the other direction. But in equilibrium, neither one of those strategies will produce a profit, and in fact the payoff would be exactly zero as long as everything is appropriately priced.